Welcome to the Explainer. So you get that notification, that little ping that says a cash dividend just landed in your investment account. It feels great, right? But it also immediately kicks off a big question.
I mean, sure, you could spend it, but if you're here, you're probably focused on long-term growth. You know that money needs to get back in the game. So the real question isn't if you should reinvest, it's how. What's the absolute smartest way to turn that dividend back into a wealth-building machine?
And that, right there, is what we're calling the dividend dilemma. It's really a choice between two very different paths, a completely automated system or a more hands-on, do-it-yourself approach. Let's start with the easy one first.
So let me introduce you to the Dividend Reinvestment Plan, or as you'll hear it called, a DRIP. It's pretty much exactly what it sounds like. It's a simple service that your brokerage offers. You sign up for it once, and that's it. From then on, every single time you get a dividend, the system just automatically uses that cash to buy more shares of the exact same stock that paid you. You can really think of it as putting your portfolio's growth on complete autopilot. It's designed from the ground up to be the ultimate set-it-and-forget-it tool for investors who want to consistently build up their positions without ever lifting a finger.
And the power of doing it this way is pretty clear. A DRIP gets your money back to work, like, right away. So the magic of compounding never takes a break. It also builds incredible discipline, because there's zero temptation to spend dividend cash that you never actually see hit your bank account. For busy investors, it's an absolute dream for saving time and mental energy.
With all those benefits, it sounds like the perfect strategy, doesn't it? A completely hands-off way to guarantee your wealth just keeps growing. Well, it's not quite that simple. And this really gets us to the heart of the matter. Using a DRIP boils down to a fundamental choice. Are you willing to give up some hands-on control in exchange for absolute convenience?
Because that convenience, it isn't exactly free. While you get that amazing discipline and automation, you do give up control over two really key factors: the price you end up paying for new shares and the fees you might be charged. So let's break down exactly what that means for your money.
All right, so let's put these two strategies head to head. We're going to compare the automated DRIP directly against a manual approach, where you take that dividend cash and decide to reinvest it all by yourself. This table breaks it all down. With a DRIP, the timing is totally fixed. It buys automatically 2 days after the dividend is paid, and usually at whatever the market's opening price is. Manually, you're in the driver's seat. You control the timing. The fees are different, and we'll get to that in a second. And this one is crucial. A DRIP forces you to buy the same stock, while the manual approach gives you the flexibility to invest that cash literally anywhere else.
Okay, let's zoom in on those fees. They might seem tiny, but trust me, this difference is a really big deal. In Taiwan, for instance, a lot of regular investment plans have a promotional flat fee of just 1 new Taiwan dollar. That is really tough to beat. So how do DRIP fees compare?
Let's just look at the raw math. A DRIP fee is usually percentage-based. So on a $10,000 dividend, even with a typical discount, that fee can work out to about $8.50. Now, that's still pretty small, but let's see how it stacks up against the other option. And there it is. Look at that difference. Manually reinvesting that exact same $10,000 with a common promotional rate could cost you just $1. For any investor who's conscious about costs, especially as your dividends get larger and larger, the manual route is the clear winner on fees. No question.
So besides the fees, there's another hidden cost we have to talk about: price risk. Here's how a DRIP actually works. The dividend cash comes in, the system sits on it for 2 trading days, and then, bang, it automatically places a buy order, a lot of the time right at the market open. So why does that matter?
Because of this. The source material warns that, and I'm quoting here, the risk that the opening price could be the day's highest point truly exists. Just think about that. If the market opens high and then sells off during the day, the DRIP system locked you into buying at that peak. With a manual plan, you could have waited, watched the price, and bought later in the day for a lot cheaper. You lose that control.
So, when it all comes down to it, there is no single best answer here. The right choice depends completely on you, on your personality, your goals, and what you value most as an investor. It all boils down to your personal style.
So who is the DRIP for? It's for the autopilot investor. This is you if what you want is ultimate convenience. You know that forcing yourself to be disciplined is the key to your success, and you just love the idea of setting something once and just forgetting about it. For you, a slightly higher fee or a less than perfect purchase price, that's a tiny price to pay for total automation.
But then again, maybe you're the hands-on captain. You want to control every single variable to squeeze out the best possible returns. You actually enjoy watching the market, choosing your moment to buy, and shaving off every little fee. And most of all, you demand the flexibility to take a dividend from one company and maybe reinvest it in a completely different one. If that's you, then manual reinvestment is your clear winner.
And that brings us right back to you. There's a powerful case for both of these strategies. One offers you maximum convenience and discipline. The other gives you maximum control and cost efficiency. Now that you've seen all the trade-offs, the only question left is, which one are you? Thanks for joining us on The Explainer.